The Japanese yen has plummeted to nearly 163 against the US dollar, marking its lowest point in 4 decades. Stick around until the end of this video to uncover why market interventions alone won't halt this historic decline, and discover the key events that might alter the rate gap. What's driving this remarkable shift? It's the ever-widening interest rate gap between Japan and the United States. As global central banks, led by the Federal Reserve, raise interest rates, the Bank of Japan keeps its borrowing costs at ultra-low levels. This significant yield differential makes holding yen less appealing, leading to capital outflows and a surge in carry trade activity, where traders borrow cheap yen to invest in higher-yielding foreign assets. As exchange rates dive below 158 and approach 163 per dollar, we witness the yen's weakest performance against G8 currencies in decades. In response, the Ministry of Finance is on alert, ready to take joint action as previously pledged with the US, a move reminiscent of their coordinated efforts since 2011. Investors are keenly monitoring the Bank of Japan's upcoming meeting on August 10, where the summary of opinions from the July 30th to 31st monetary policy meeting will be released, hoping for any hints on future policy adjustments. Traders are sounding the alarm across social media platforms like X. They're engaging in lively discussions, pointing out that while interventions can provide a short-term fix, they fail to address the underlying rate gap that fuels ongoing selling pressure. With US 2-year yields rising, the yen continues to face relentless selling. Many on X are noting that past intervention levels are being tested, signaling a disregard for official currency policy limits. Analysts and market watchers are clear: foreign exchange intervention alone cannot bridge the structural rate gap. While efforts to sell dollars may slow the pace of decline, they won't change the fundamental yield disparity. As long as the Bank of Japan maintains a looser monetary policy than the US Federal Reserve, capital will keep flowing out of Japan in search of better returns. The yen's sharp decline creates a complex landscape for Japanese equities and global investors alike. While a weaker currency typically benefits Japan's export-heavy companies, extreme volatility and capital outflows introduce significant risks. Ongoing yen depreciation suggests a flight of capital from domestic investments to higher-yielding foreign markets, forcing investors to weigh immediate corporate gains against broader macroeconomic instability. The yen's descent to 40-year lows isn't just a local issue, it's sending ripples across global markets. As a major source of liquidity, Japan's ongoing carry trades are impacting foreign exchange dynamics worldwide. If currency interventions provoke a swift unwinding of these trades, we could see significant volatility ripple through international equity and commodity markets. For individual investors, navigating this extreme currency weakness means exercising strict risk management and staying alert to policy signals. Relying solely on official interventions to reverse the trend is risky. Historically, such actions do not stop long-term macro trends shaped by interest rate differentials. Investors should keep a close watch on central bank communications, especially policy summaries and bond yield trends, while steering clear of over-leveraged currency positions. Looking ahead, scenario analysis powered by AI outlines 3 potential paths for US dollar to Japanese yen. In the base case, the yen remains under pressure, hovering around 160 to 163 as long as the rate gap persists, with any interventions offering only temporary reprieves. Alternatively, a bullish yen scenario could emerge if the BOJ shifts to a hawkish stance or if aggressive rate cuts are anticipated in the US, narrowing the yield gap and possibly driving a rally below 150. On the flip side, a bearish scenario could see US dollar to Japanese yen breaking historic records if US inflation persists and the BOJ remains hesitant. In conclusion, the persistent rate differentials are the key drivers behind yen weakness, and while intervention may provide short-term relief, it cannot address the structural yield gaps. The upcoming central bank policy releases are crucial for understanding the yen's future. What are your thoughts on where the yen is headed? Let us know in the comments, like this video, and subscribe for weekly insights into macroeconomic trends.